Good afternoon, traders. Welcome to this very special edition of The Market Explodes right in front of us, Pirate Traders live stream. All right, these FOMC notes will be released in 3 minutes. What are we expecting? Well, a lot of volatility, a lot of uncertainty, very fast tempo, and a very unpredictable market. It is worth noting a lot of times the market will make a move in one direction. It will seem like it's going to get continuation, and then out of nowhere it will reverse very, very harshly. So don't get overly excited right away. And any trade you're going to get into, take profits very, very quickly. Do not fall in love with the trade. This market can reverse on you in a second. Generally what happens is right when that bell rings for 2 o'clock, the market will go nuts, and that'll last about 15 minutes or so. Then it'll kind of calm down. It'll slow down a little bit. And then when the Fed chair starts to speak at 2:30, then it'll pick up again, and the tempo will pick up and the volatility will pick up. And of course, we will watch that, watch the live stream of him talking here on the channel as well. If you're new to the channel, welcome. We talk about market profile, but today, in this episode, in this moment, there won't be a lot to say. I'll kind of just be watching what the market's doing and make my best guess at understanding it. Uno momento. If you wouldn't mind just pushing that thumbs up button, we got 100 people hanging out. Only 26 likes. Maybe we can pump those likes before Jerome Powell pumps the fear and greed. Coop, get ready to gamble. That's it. You nailed it. All right, there you go. Ooh, they're actually early. They're front running it by a minute. It's also interesting to note, just like before the murder bot, all of the liquidity disappeared on the market 5 minutes beforehand. So just like the murder bot, they shut off the algorithms before this happens to protect themselves. Looks like the first impulse is to the downside. Tested yesterday's VPOC. We should expect to find some support in here. Charles, it's moving too fast. I can't take it. Yep, get ready. Get ready for the next 15 minutes. Remember what I said, the first direction they go, they will always convince you it's about to keep going that way forever. And then out of nowhere, they're right back up. So if you're shorting this, take profits quickly. Don't wait around. Yep, 75 basis point hike. We're now at 3.25% on the interest rate, which is what everybody expected. So now the question is, was this priced in, or is the market about to be shocked and make a big move? Okay, so now we're coming down here and we're testing this balance area low that we've developed. So once again, I just feel like I have to keep reiterating, I don't know what the market's going to do, but it wouldn't surprise me in the least if out of nowhere here it just came right back up. To truly expect further downside continuation, I'd need to see us break that low at 43 and then get more selling down there. And it looks like I'm going to get my chance. Ask and you shall receive, Charles. Ask and you shall receive. Okay, so here's where we'd be looking for resistance if they wanted to take the market lower. Nap cut through the balance area low like butter. Yeah, but that's okay, right? You can get what's called a look below and fail, where they try to test lower, and then when they can't, it pops back up and goes right to the opposite end. So really what will be bearish now is resistance here. If they can't pop back up, if the selling continues, that's where it's really dangerous. Or not dangerous, bearish. Kathy, what are you anticipating Powell to say? I mean, I don't know. No idea. I assume he's going to be the same as Jackson Hole. I assume he's going to be saying we need pain. All right, here's our reversal. So that's a look below and fail of the balance area, increasing the odds that we're rotating to the opposite end of balance. Obviously, we don't know. Anything could happen. This is a completely, anything could happen market. But that's generally the way it works. If you try to look below a balance area, you end up heading to the other way if you can't get resistance there. Hitting dingers, best book to read to study volume profile. I don't know a volume profile book specifically, but I like Jim Dalton's books for market profile, and that covers both volume and TPO. So I would say Mind Over Markets or Markets in Profile are a great place to start. Skewball's calling for resistance. It could be, man. It's right in that node. It's interesting that we started a reverse and right there is where the two-sided trade picked up. But I just feel like it's too early to make the call for sure. That's the fun of gambling. What does the orange color up there mean? That's the volume that was trading earlier in the day. So this was basically from like 12:30 to 150 or 155. That's the volume that was trading up in there. And obviously that was bots, right? That was just computers picking each other's pockets, picking day traders' pockets. And what we have now recognized is a common pattern before a major event, which is statistically unpredictable. All those bots turn off. And so just exactly 5 minutes before 2 o'clock, they all turned off and that volume disappeared. It also happens every single day, 5 minutes or 15 minutes before the close. All the bots just boop, shut down. The market is free for about 5 minutes, and then the new set of murder bots come in. Charles, you keep talking about algorithms all the time. You're obsessed with algorithms. Computers, computers, computers. If you don't think that that's computers, I can't help you. If you really think that all the millions and millions of traders simultaneously pulled their liquidity at the exact same moment, well, you do you. All right, well, this is bearish. We're back below yesterday's low. We did get resistance. So it looks like the market wants to take it lower. We got support here at about 38.30. And then we're looking to repair the week low down at 38.20 if that support doesn't hold. Jeremy Jones says, I would wait until the press conference. It looks like you and all the big boys. Look at how much total volume is trading in here. This is nothing. This is just us. It's just retail. Freaking out. Oh my God. 75 basis points. Ah. We'll start to see the volume come in as Papa Powell starts to talk. Kassane, is there a time frame old gaps lose some of their relevance, or do they remain the same importance no matter if it's from a day back or like the 15th of June? I would say like gaps are most important, like, within a day or two of them being created. Particularly if they don't get filled. Like if you gap up one day, you closed here, you open up here, you gap up. If you try to fill the gap and then you continue higher, that's still very, very important, at least for the next few days. But then after that, it's really, you don't really worry about it. It's more like something to think about once the market's coming back down. So if later on, and that doesn't matter. It might be, there might be a gap left behind in the SPX from like 5 years ago. And I'm not going to think about that right now. Who cares? But if we start to get down close to that level, I'll use that gap as a potential target. That gap fill as a potential target. But I would say I only really take gaps into worrying about how it'll affect the market like right now today within like a day or two. After that, they're just targets if the market's heading there. Same thing with poor references. Okay, so this is usually when the market kind of slows down for a little bit and kind of levels out. And then when he starts talking in about 10 minutes, the volatility will pick up again. Joe Park, possibly one-way market after the conference. I can't predict that. It's too hard. We got to just wait and see. Anyone who tells you they can predict what's going to happen now is lying to you. Once Papa Powell starts talking, anything is possible. If you're looking for certainty right now, do not trade. Do not trade. You're done for the day. If you want any sort of certainty in anything, this is a gambler's market. You're going to guess. You're going to clench those butt cheeks real tight and hope it works out. That's all you can do. Vegas, baby. Chris just cracked a walnut. with your downstairs parts. If you're cracking walnuts, your position size might be a little too big. Laser eye. It's great advice. Just use a 300-point stop. You'll be fine. You won't get stopped out. Scott, how much was the hike? 75 basis points. We're now at 3.25. I have to admit, man, it's kind of cool watching this on, watching this on this chart. Like the way you can see the volume coming in. You can see how they were like, nope, not messing with it. And now slowly but surely, they're starting to, okay, let's give it a try. Let's start testing out some support and resistance. Rocket, a ton of trap sellers on the bottom getting pinched. To be fair, for FOMC, that's not that bad. I could have just as easily seen it push all the way back up into the range. Okay, so now they're starting to, they're thinking we're not going to get to the lows. They're pulling the volume from here, and they're moving it higher. See that switch? You see how as soon as this volume disappeared, it started to build in here, and in here? They're shifting their orders higher. They want to get long the market, and they're thinking they won't get a chance down here. Ed Powell will be speaking soon. Yes, sir. 2 minutes. 2 minutes, Turkish. All right. I'm going to go quiet here, and we'll just listen to Papa Powell. If there's anything that I feel like is worth discussing, I will bring it up. Otherwise, we'll just listen to Powell speak and watch the market's response.
Good afternoon. My colleagues and I are strongly committed to bringing inflation back down to our 2% goal. We have both the tools we need and the resolve that it will take to restore price stability on behalf of American families and businesses. Price stability is the responsibility of the Federal Reserve and serves as the bedrock of our economy. Without price stability, the economy does not work for anyone. In particular, without price stability, we will not achieve a sustained period of strong labor market conditions that benefit all. Today, the FOMC raised its policy interest rate by 0.75 percentage point, and we anticipate that ongoing increases will be appropriate. We are moving our policy stance purposefully to a level that will be sufficiently restrictive to return inflation to 2%. In addition, we are continuing the process of significantly reducing the size of our balance sheet. I will have more to say about today's monetary policy actions after briefly reviewing economic developments. The U.S. economy has slowed from the historically high growth rates of 2021, which reflected the reopening of the economy following the pandemic recession. Recent indicators point to modest growth of spending and production. Growth in consumer spending has slowed from last year's rapid pace, in part reflecting lower real disposable income and tighter financial conditions. Activity in the housing sector has weakened significantly, in large part reflecting higher mortgage rates. Higher interest rates and slower output growth also appear to be weighing on business fixed investment, while weaker economic growth abroad is restraining exports. As shown in our summary of economic projections, since June, FOMC participants have marked down their projections for economic activity, with the median projection for real GDP growth standing at just 0.2% this year and 1.2% next year, well below the median estimate of the longer-run normal growth rate. Despite the slowdown in growth, the labor market has remained extremely tight, with the unemployment rate near a 50-year low, job vacancies near historical highs, and wage growth elevated. Job gains have been robust, with employment rising by an average of 378,000 jobs per month over the last 3 months. The labor market continues to be out of balance, with demand for workers substantially exceeding the supply of available workers. The labor force.
So we just broke through this major resistance that we had at 3860. So now the question becomes, do they flip the book? Do they start to take all this volume that was waiting to fill down here, and do they start to pull it up to here to turn it into support? That will be very important if they want to keep this move going higher. They got to flip those orders. So let's see what happens.
Inflation remains well above our 2% longer run goal. Over the 12 months ending in July, total PCE prices rose 6.3%. Excluding the volatile food and energy categories, core PCE prices rose 4.6%. In August, the 12-month change in the Consumer Price Index was 8.3%, and the change in the core CPI was 6.3%. Price pressures remain evident across a broad range of goods and services. Although gasoline prices have turned down in recent months, they remain well above year-earlier levels, in part reflecting Russia's war against Ukraine, which has boosted prices for energy and food and has created additional upward pressure on inflation. The median projection in the SEP for total PCE inflation is 5.4% this year and falls to 2.8% next year, 2.3% in 2024, and 2% in 2025. Participants continue to see risks to inflation as weighted to the upside. Despite elevated inflation, longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets. But that is not grounds for complacency. The longer the current bout of high inflation continues, the greater the chance that expectations of higher inflation will become entrenched. The Fed's monetary policy actions are guided by our mandate to promote maximum employment and stable prices for the American people. My colleagues and I are acutely aware that high inflation imposes significant hardship as it erodes purchasing power, especially for those least able to meet the higher costs of essentials like food, housing, and transportation. We are highly attentive to the risks that high inflation poses to both sides of our mandate, and we are strongly committed to returning inflation to our 2%.
We still haven't brought in any support here. This is so I love watching this on Bookmap. You can see they're pulling their orders. We're getting less and less volume down here. So they're giving up on getting an entry there, but they're not really moving it anywhere. So that, I mean, I'm just guessing, but I would think that that would mean they need to come back down and test this and make a decision once we come down there. Or that they've completely given up on getting long, that this was all they're going to get. And now they're just taking profits on it. Anyway, I'm just thinking out loud. Back to Papa Powell.
At some point, as the stance of monetary policy tightens further, it will become appropriate to slow the pace of increases while we assess how our cumulative policy adjustments are affecting the economy and inflation. We will continue to make our decisions meeting by meeting and communicate our thinking as clearly as possible. Restoring price stability will likely require maintaining a restrictive policy stance for some time. The historical record cautions strongly against prematurely loosening policy. As shown in the SEP, the median projection for the appropriate level of the federal funds rate is 4.4% at the end of this year, 1 percentage point higher than projected in June. The median projection rises to 4.6% at the end of next year and declines to 2.9% by the end of 2025, still above the median estimate of its longer run value. Of course, these projections do not represent a committee decision or plan, and no one knows with any certainty where the economy will be a year or more from now. We are taking forceful and rapid steps to moderate demand so that it comes into better alignment with supply. Our overarching focus is using our tools to bring inflation back down to our 2% goal and to keep longer-term inflation expectations well anchored. Reducing inflation is likely to require a sustained period of below-trend growth, and there will very likely be some softening of labor market conditions. Restoring price stability is essential to set the stage for achieving maximum employment and stable prices over the longer run. We will keep at it until we're confident the job is done. To conclude, we understand that our actions affect communities, families, and businesses across the country, Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you, and I look forward to your questions.
Hi, Chair Powell. Thank you for taking our questions. Gina Smilik from the New York Times. I wonder if you could give us a little detail around how you'll know when to slow down these rate increases and how you'll eventually know when to stop.
So I will answer your question directly, but I want to start here today by saying that my main message has not changed at all since Jackson Hole. The FOMC is strongly resolved to bring inflation down to 2%. And we will keep at it until the job is done. So the way we're thinking about this is the overarching focus of the committee is getting inflation back down to 2%. To accomplish that, we think we'll need to do two things in particular to achieve a period of growth below trend and also some softening in labor market conditions to foster a better balance between demand and supply in the labor market. So on the first, committee's forecasts and those of most outside forecasters do show growth running below its longer run potential this year and next year. On the second, though, so far there's only modest evidence that the labor market is cooling off. Job openings are down a bit. As you know, quits are off their all-time highs. There's some signs that some wage measures may be flattening out but not moving up. Payroll gains have moderated, but not much. And in light of the high inflation we're seeing, we think we'll need to, and in light of what I just said, we think that we'll need to bring our funds rate to a restrictive level and to keep it there for some time. So what will we be looking at, I guess, is your question. So we'll be looking at a few things. First, we'll want to see growth continuing to run below trend. We'll want to see movements in the labor market showing a return to a better balance between supply and demand. And ultimately, we'll want to see clear evidence that inflation is moving back down to 2%. So that's what we'll be looking for. In terms of reducing rates, I think we'd want to be very confident that inflation is moving back down to 2% before we would consider that.
Steve.
Thank you, Mr. Chairman. Steve Leisman, CNBC. Can you talk about how you factor in the variable lags on inflation and the extent to which the outlook for rates should be seen as linear in the sense that you keep raising rates, or can you envision a time when there's a pause to kind of look at what has been wrought in the economy from the rate increases? Thank you.
Sure. So, of course, monetary policy does famously work with long and variable lags. The way I think of it is our policy decisions affect financial conditions immediately. In fact, financial conditions have usually been affected well before we actually announce our decisions. Then changes in financial conditions begin to affect economic activity fairly quickly, within a few months. But it's likely to take some time to see the full effects of changing financial conditions on inflation. So we are very much mindful for that. And that's why I noted in my opening remarks that at some point, as the stance of policy tightens further, it will become appropriate to slow the pace of rate hikes while we assess how our cumulative policy adjustments are affecting the economy and inflation. So that's how we think about that. Your second question, sorry, was?
Is there a point in time you could see pausing? Is it linear that you keep raising rates, or is there? Oh, I'm sorry. I should know better than to not talk with my microphone.
I should know better than to answer your second question.
Oh, there you go. Is it linear? Do you keep raising rates, or is there a pause that you could envision where you kind of figure out what has happened to the economy and give time to catch up in the real economy, the rate increase time to catch up in the real economy? Thank you.
So I think it's very hard to say with precise certainty the way this is going to unfold. As I mentioned, what we think we need to do and should do is to move our policy rate to a restrictive level that's restrictive enough to bring inflation down to 2%, where we have confidence of that. And what you see in the SEP numbers.
All right, well, this isn't a call that I could take a trade for. I don't have enough confidence in it. But it's starting to feel like this is already priced into the market, right? And if it's already priced in, And we've got ourselves a balance area. I know I've said this multiple times this morning already, but when you test a balance area low, the next stop is a balance area high. So there's a very real chance they could pump this into the 39.20s here if they can keep it going.
Our questions. The projections show the unemployment rate rising to 4.4% next year. And historically, that kind of rise in the unemployment rate would typically bring a recession with it. Should we interpret that to mean no soft landing? And is that kind of rise necessary to get inflation down?
Right. So you're right. In the SEP, there's what I would characterize as a relatively modest increase in the unemployment rate from a historical perspective, given the expected decline in inflation. Now, why is that? So really, that is what we generally expect, because we see the current situation as outside of historical experience in a number of ways, and I'll mention a couple of those. First, and you know these, but first, job openings are incredibly high relative to the number of people looking for work. It's plausible, I'll say, that job openings could come down significantly, and they need to, without as much of an increase in unemployment as has happened in earlier historical episodes. So that's one thing. In addition, in this cycle, longer run inflation expectations have generally been fairly well anchored. And as I've said, there's no basis for complacency there. But to the extent that continues to be the case, that should make it easier to restore price stability. And I guess the third thing I would point to.
Okay, so do we get some resistance here? And then pull back down into the range, looking for support around the C period high. Kathy, I see a possible short looking for resistance above. It's risky, but it's a gamble. You know, you can give it a try.
Are vacancies still at the top of your list in terms of understanding the labor market and how much room there is there?
Yes, vacancies are still almost 2-to-1 ratio to unemployed people. That and quits are really very good ways to look at how tight the labor market is and how different it is from other cycles, where generally the unemployment rate itself is the single best indicator. We think those things have for quite a time now really added value in terms of understanding where the labor market is.
Nick.
Nick Timmeros at the Wall Street Journal. You said not too long ago in describing the policy destination, there's still a way to go. But I imagine you have to have some idea about how you're thinking about your destination, whether it's a stopping point or a pausing point. And so I was wondering if you could discuss how you are thinking about, as the data come in, where that destination is, how it's moving up if inflation doesn't perform as you expect. Do you want to have a policy rate that's above the underlying inflation rate, for example? And do you have an estimate for where you think the underlying inflation rate might be in the economy right now?
Well, so again, we we believe that we need to raise our policy stance overall to a level that is restrictive. And by that I mean is meaningfully putting meaningful downward pressure on inflation. That's what we need to see in the stance of policy. We also know that there are long and variable lags, particularly as they relate to inflation. So,
boy, this market is really moving. So if this area around the point of control for today can't act as support, we might have a look above and fail of the balance area heading back down. So the buyers need to step in here and defend this if they want to hold the market up.
Where real rates are positive across the entire yield curve. And I think that would be the case if you look at the numbers that we're writing down and think about, you measure those against some sort of forward-looking assessment of inflation expectations. I think you would see at that time, you'd see positive real rates across the yield curve, and that is also an important consideration.
Hi, Howard Schneider with Reuters. Thanks for the opportunity. I just want to be clear on the steps. You say it's meeting by meeting, but it sure looks like we're going 75, 50, 25. Is 75 next month the baseline?
So we make one decision per meeting, and the meeting decision we made today was to raise the federal funds rate by 75. You're right that the median for the year end suggests another 125 basis points in rate increases, but there's another fairly large group that saw 100 basis points addition to where we are today. So that would be 25 basis points less. So we're going to make that decision at the meeting. We didn't make that decision today. We didn't vote on that. I would say that we're committed to getting to a restrictive level of for the federal funds rate and getting there pretty quickly, and that's what we're thinking about.
So just as a follow-up to that, I'm wondering about the sort of risk management considerations here. Given there's some discussion now of overdoing it, what's the incentive to continue front-loading right now? Is it lack of progress on inflation seen in the CPI reports, or is it a motivation to get as much done while the job market is still as strong as it is?
So what we've seen is inflation our expectation has been that we would begin to see inflation come down, largely because of supply side healing. By now, we would have thought that we would have seen some of that. We haven't. We have seen some supply side healing, but inflation has not really come down. If you look at core PCE inflation, which is a good measure of where inflation is running now, if you look at it on a 3, 6, and 12-month trailing annualized basis, you'll see that inflation is at 4.8%, 4.5%, and 4.8%. So that's a pretty good summary of where we are with inflation, and that's not where we expected or wanted to be. So what that tells us is that we need to continue, and we can keep doing these, and we did today do another large increase as we approach the level that we think we need to get to. And we're still discovering what that level is, but people are writing that down in their SEP where they think policy needs to be. So that's how we're thinking about it.
Let's go to Colby. Thank you. Colby Smith with the Financial Times. Chair Powell, how should we interpret the fact that core inflation is still not forecast in the SEP to be back to target in 2025, and yet the dot plot projects cuts as early as 2024? And does that mean there's a level of inflation above the 2% target that the Fed is willing to tolerate?
So I guess core is at 2.1 in 2025, and in the median, and headline is at 2.0. So that's pretty close. I mean, we write down our forecasts and we figure out what the median is and we publish it. So it's not. I would say that if the economy followed this path, this would be a pretty good outcome. But you're right, it is a tenth higher than 2%.
Okay, just as a quick follow-up, I mean, if the concern is that underlying inflation is becoming more entrenched perhaps each month, then why forego the more aggressive 100 basis point increase today? And does that risk having to do more later on?
Yeah, so we, as we said, at the last press conference and in between that one and this one, we said that we would make our decision based on the overall data coming in. So if you remember, we got a surprisingly low reading in July, and then a surprisingly high reading for August. So I think you never want to overreact too much to any one data point. So if you look at them together, and as I just mentioned, if you really look at this year's inflation, 3, 6, and 12-month trailing, you see inflation is running too high. It's running 4.5% or above. You don't need to know much more than that. If that's the one thing you know that this committee is committed to getting to a meaningfully restrictive stance of policy and staying there until we feel confident that inflation is coming down. So that's how we think about it.
Victoria.
Hi, Victoria Guida with Politico. I wanted to ask about the balance sheet. You all have left open the possibility that you might sell mortgage-backed securities, but we've seen significant slowing in the housing market. Mortgage rates have gone up significantly, and I'm just wondering whether conditions there might affect your plans for how quickly you have the runoff on the MBS side.
So what we said, as you know, was that we would consider that once balance sheet runoff is well underway. I would say it's not something we're considering right now, and not something I expect to be considering in the near term. It's just it's something I think we will turn to, but the time for turning to it has not come and is not close.
Well, and will conditions in the housing market affect that decision?
I think a number of things might affect that decision, but the main thing is we're not considering that decision, and I don't expect that we will anytime soon.
Neil.
Thanks. Neil Irwin with Axios. A number of commentators have come to the view, and including over at the World Bank, that simultaneous global tightening around the world creates a risk of a global recession that's worse than is necessary to bring inflation down. How do you see that risk? How do you think of coordination with your fellow central bankers? And is there much risk of overdoing it on a global level?
So we actually, my colleagues and I, a number of my FOMC colleagues and I just got back from one of our frequent trips to Basel, Switzerland, to meet with other senior central bank officials from around the world. We are in pretty regular contact, and we exchange. Of course, we all serve a domestic mandate, domestic objectives, in our case, the dual mandate, maximum employment price stability. But we regularly discuss what we're seeing in terms of our own economy and international spillovers. And it's a very ongoing, constant kind of a process. So we are very aware of what's going on in other economies around the world and what that means for us and vice versa. The forecast that we put together, that our staff puts together and that we put together on our own, always try to take all of that into account. I mean, I can't say that we do it perfectly, but it's not as if we don't think about the policy decisions, monetary policy and otherwise, the economic developments that are taking place in major economies that can have an effect on the U.S. economy. That is very much baked into our own forecast and our own understanding of the U.S. economy as best we can. It won't be perfect. So, I don't see it's hard to talk about collaboration in a world where people have very different levels of interest rates. If you remember, there were coordinated cuts and raises and things like that at various times, but really we're in very different situations. But I will tell you that our contact is more or less ongoing, and it's not coordination, but there's a lot of information sharing, and we all, I think, are informed by what other important economies that are important to the United States are doing.
Craig.
Craig Torres from Bloomberg. Chair Powell, you talked about some ways the higher interest rates are affecting the economy, but we've also seen a resilient labor market with durable consumption, strong corporate profits. And I'm wondering what your story is on the resilience of the economy. After all, you and your colleagues said, well, we started tightening in March when we were talking about interest rates in the future. And indeed, Treasury rates moved up. So we should have had a lot of tightening taking effect. Why is the economy, in your view, so resilient? And does it mean that we might need a possibly higher terminal rate?
You're right, of course. The labor market in particular has been very strong. But there are the sectors of the economy that are most interest rate sensitive are certainly showing the effects of our tightening. And of course, the obvious example is housing, where you see declining activity and of all different kinds, and housing price increases moving down. So we're having an effect on interest-sensitive spending. I think through exchange rates, we're having an effect on exports and imports. I think so. All of that's happening. But you're right. And we've said this. This is a strong, robust economy. People have savings on their balance sheet from the period when they couldn't spend and where they were getting government transfers. There's still very significant savings out there, although not as much at the lower end of the income spectrum, but still some savings out there to support growth. The states are very flush with cash, so there's a good reason to think that this will continue to be a reasonably strong economy. Now, the data sort of are showing that growth is going to be below trend this year. We think of trend as being about 1.8% or in that range. We're forecasting growth well below that, and most forecasters are. But you're right. There's certainly a possibility that growth can be stronger than that, and that's a good thing because that means the economy will be more resistant to a significant downturn. But of course we are focused on the thing I started with, which is getting inflation back down to 2%. We can't fail to do that. If we were to fail to do that, that would be the thing that would be most painful for the people that we serve. So for now, that has to be our overarching focus. And you see that, I think, in the SEP, in the levels of rates that we'll be moving to reasonably quickly, assuming things turn out roughly in line with the SEP. So that's how we think about it.
Mike, thank you.
Thank you, Mr. Chairman. In a world of euphemisms that we live in here with below-trend growth and a modest increase in unemployment, I'm wondering if I could ask you a couple of direct questions for the American people. Do the odds now favor, given where you are and where you're going with interest rates, favor a recession? 4.4% unemployment is about 1.3 million jobs. Is that acceptable job loss? And then given that the data you look at is backward-looking and the lags in your policy are forward-looking and you don't know what they are, how will you know, or will you know, if you've gone too far?
So I don't know what the odds are. I think that there's a very high likelihood that we'll have a period of what I've mentioned is below trend growth, by which I mean much lower growth, and we're seeing that now. So the median forecast, I think, this year for among my colleagues and me was 0.2% growth. So that's very slow growth, and then below trend next year. I think the median was 1.2, also well below. So that's a slower. That's a very slow level of growth, and it could give rise to increases in unemployment. But I think that is something that we think we need to have, and we think we need to have softer labor market conditions as well. We're never going to say that there are too many people working, but the real point is this: inflation. What we hear from people when we meet with them is that they really are suffering from inflation, and if we want to set ourselves up, really light the way to another period of a very strong labor market, we have got to get inflation behind us. I wish there were a painless way to do that. There isn't. So what we need to do is get rates up to the point where we're putting meaningful downward pressure on inflation, and that's what we're doing. And we certainly don't hope. We certainly haven't given up the idea that we can have a relatively modest increase in unemployment. Nonetheless, we need to complete this task.
Well, how will you know, or will you know, if you've gone too far?
It's hard to hypothetically deal with that question. I mean, our really tight focus now continues to be ongoing rate increases to get the policy rate up where it needs to be. And as I said, you can look at this SEP as today's estimate of where we think those rates would be. Of course, they will evolve over time.
Chris Rugaber.
Thanks. Chris Rugaber, Associated Press. I wanted to follow up with what you just mentioned about the labor market. You've said several times that to have the labor market we want, we need price stability, and you've suggested maybe there isn't a trade-off in the long run. But in the short run, there is a lot of concern, as people have been expressing here, about higher unemployment as a result of these rate hikes, or as a result of the rate hikes. So can you explain, though, what about high inflation now threatens the job market? I mean, you seem to suggest that inflation, high inflation will eventually lead to a weaker job market. So can you spell that out a little more for the general public and how that would work?
So for starters, people are seeing their wage increases, their wage increases eaten up by inflation. So if your family is one where you spend most of your paycheck, every paycheck cycle, on gas, food, transportation, clothing, basics of life, and prices go up the way they've been going up, you're in trouble right away. You don't have a cushion, and this is very painful for people at the lower end of the income and wealth spectrum. So that's what we're hearing from people is, it very much that inflation is really hurting. So how do we get rid of inflation? And as I mentioned, it would be nice if there were, a way to just wish it away, but there isn't. We have to get supply and demand back into alignment, and the way we do that is by slowing the economy. Hopefully, we do that by slowing the economy, and we see some softening in labor market conditions, and we see a big contribution from supply side, improvements and things like that. But none of that is guaranteed. In any case, our job is to deliver price stability, and I think you can think of price stability as an asset that just delivers large benefits to society over a long period of time. We really saw that for a long time. The United States had 2% inflation, didn't move around much, and that was enormously beneficial to the public that we serve. And we have to get back to that and keep it for another long period of time. To pull back from the task of doing that is you're just postponing. The record shows that if you postpone that, the delay is only likely to lead to more pain. So, I think we're moving to do what we need to do and do our jobs, and that's what you see us doing.
Thank you for taking the question, Mr. Chairman. Edward Lawrence for Fox Business. So you had said that Americans and businesses need to feel some economic pain as we go forward. How long from here should Americans be prepared for that economic pain?
How long? I mean, it really depends on how long it takes for wages and more than that, prices to come down, for inflation to come down. And what you see in our projections today is that inflation moves down, significantly over the course of next year, and then more the next year after that. And I think once you're on that path, that's a good thing, and things will start to feel better to people. They'll feel lower inflation. They'll feel that the economy's improving, and also if our projections are close to right, you will see that that the costs in unemployment they're meaningful, and they're certainly very meaningful to the people who lose their jobs, and we talk about that in our meetings quite a lot. But at the same time, we'd be setting the economy up for another long period. This era has been noted for very long expansions. We've had 3 of the 4 longest in measured history since we got inflation under control. And that's not an accident. So when inflation is low and stable, you can have these 9, 10, 11, 10-year, expansions. And you can see what we saw in 2018, 19, and 20, which was very low unemployment, the biggest wage gains going to people at the low end of the spectrum, the smallest racial gaps that we've seen since we started keeping track of that. So we want to get back to that, but to get there, we're going to have to get supply and demand back in alignment, and that's going to take tight monetary policy for a period of time.
As a follow-up, what is that economic pain in your mind? Is it job losses? Is it higher interest rates on credit cards? What is that economic pain?
So it's all of those things. Higher interest rates, slower growth, and a softening labor market are all painful for the public that we serve. But they're not as painful as failing to restore price stability and then having to come back and do it down the road again, and doing it at a time when actually now people have really come to expect, high inflation. If the concept of high inflation becomes entrenched in people's economic thinking about their decisions, then sort of getting back to price stability, the cost of getting back to price stability just rises. And so we want to avoid that. We want to act aggressively now and get this job done and keep at it until it's done.
Nicole from CNN. Thank you, Chairman Powell. Nicole Goodkind, CNN Business. Existing home sales have fallen for 7 months straight. Mortgage rates are at their highest level since 2008. Yet mortgage demand increased this week, and housing prices are still elevated. Now, at the end of your June press conference, you mentioned plans to reset the housing market. I was wondering if you could elaborate on what you mean when you say reset, and what you think it will take to actually get there.
So when I say reset, I'm not looking at a particular specific, set of data or anything. What I'm really saying is that we've had a time of a red hot housing market all over the country, where, famously houses were selling to the first buyer at 10% above the ask before even seeing the house, that kind of thing. So there was a big imbalance between supply and demand. Housing prices were going up at an unsustainably fast level. So the deceleration in housing prices that we're seeing should help bring sort of prices more closely in line with rents and other housing market fundamentals. That's a good thing. For the longer term, what we need is...
All right. Well, to me, this is pretty bearish. It seems like the sellers have done an excellent job of positioning themselves to take the market lower here. And same as I said before, a balance area, it seems ridiculous, but it's like you test the low. If you don't go lower, you head up to test the high. If you don't go higher, you head down to test the low, over and over and over again. And it's just, with this volatility, it's happening instantly. So yeah, this is pretty bearish to me to head back down to start looking for support.
Hot CPI report that we saw. Do you think that there is a lag and that we will see that come down in the coming months, or do you think that there's still this imbalance that needs to be addressed?
I think that shelter inflation is going to remain high for some time. We're looking for it to come down, but it's not exactly clear when that will happen. So it may take some time. So I think hope for the best, plan for the worst. So I think on shelter inflation, you've just got to assume that it's going to remain pretty high for a while.
Okay, we'll go to Jean for the last question. Hi, Jean Young with Market News. You've talked about the need to get real rates into positive territory, and you said earlier that policy is just moving into that territory now. So I'm curious, how restrictive is rates at 4.6% expected? Is that expected to be next year? How restrictive?
So I think if you look, when we get to, let's assume we do get to that level, which I think is likely, what you're going to do is you're going to adjust that for some forward-looking measure of inflation, and that could be, you pick your measure. It could be, there are all kinds of different things you can
Here's
pick
a potential
and you get. But what you'll
support around
get is a
56.
positive number.
Can it
In
hold?
all cases, you will get forward
Or do we
inflation
crash and
expectations
burn right
in the short
through?
term, I think, that are going to be
back down towards the lows.
assuming that we're doing our jobs appropriately, that will be significant. So you'll have a positive federal funds rate at that point, which could be 1% or so. But I don't know exactly what it would be, but it would be significantly positive when we get to that level. And let me say, we've written down what we think is a plausible path for the federal funds rate. The path that we actually execute will be enough. It will be enough to restore price stability. So this is something that, as you can see, they've moved up, and we're going to continue to watch incoming data and the evolving outlook, and ask ourselves whether our policy is in the right place as we go. Thank you very much.
All right. There you go. Well, that was fun. Everybody okay? Is everyone still with us? Hope nobody got their faces melted off there. Wow, that was really cool to watch on Bookmap. I have to admit, it is absolutely fascinating to watch the way the moves are read and then traded based purely on volume and how it's moving. It was very cool. Anyway, interesting. Okay, so where do we go from here? What do we expect now? I would say for the rest of the day today, we're just going to bounce around inside the range here. We probably get resistance up here around 98 and kind of just grind around inside the value area. And then we got to just wait for tomorrow to see where we open in relation to today. Because on a bigger picture, this is a balance area. I mean, you can't question it now. It worked perfect. So this is a balance area. So bigger picture, really, we need to break this balance before we know what the market's going to do. If they can break above the highs here, they can head back up. If they can break below the lows here, they can head back down. And we may spend a few days bouncing around inside the range. I would say all in all, this digestion really means nothing. It really means the market had already priced in what he said. They were expecting it. Nobody was really surprised. And all this volatility was just games that we played with ourselves. We just picked each other's pockets for a good hour there, as harshly as we could. And now it's back to business as usual. James, can I exhale now? Yeah. At this point, this volatility that we're getting is just people taking profits, getting out of their positions. Things are settling down. We're getting back to normal here. And surprise, surprise, we're doing it right at the fairest price to do business. Man, look at the internals. Just whipsawed. Even Bitcoin made a range low from 18.6 to a range high of 19.9. It's like somebody dropped a grenade in the pond. The thing exploded for like an hour and a half, and then now it's back to normal. Meso, all he said was bad news, yet we rally. Why? It's a great question. The concept is what's called the ideas being priced in, meaning everybody already knew everything he was going to say. They already knew all those bad things. And the people who chose to buy the market, like we could just look at a daily chart and kind of zoom out and see it happen. So the market was super scared and super bearish. The people that have been accumulating in here for the last few days that have been holding up the market, the fact that they didn't hear any new bad news means they've got no reason to sell. So the selling would be new people panicking, being like, oh my God, he just said what? And then they sell out of fear. But the fact that there's no new information, there's no shock, there's no surprise, they don't need to take the market lower. So now the two-way auction starts again, and we must just decide, how do we want to break this balance area? Right? This is now a balance area. Just like every other balance area, this one they chose to break to the upside, this one they chose to break to the downside, this one they chose to break to the upside, this one they chose to break to the upside, this one they chose to break to the downside. Just like every other balance area, the way we'll have to make a decision moving forward is breaking out at the higher low of that and then getting continuation. I don't think that'll happen today. Maybe tomorrow. Chilling with Dylan. Cumulative tick has been above zero all day, even after the FOMC. Well, I hope you weren't trading off the cumulative tick up here. Boy, that cumulative tick was not reliable. Chirp, is it mostly bots during FOMC? Oh, without a doubt. Did you watch the way the volume was moving in the book map? No human could function that quickly. I mean, it was like put in some volume. Doesn't get filled? Move it, move it, move it. Up, down, over. Resistance, bring it back to here. Put it in. It was like, dude, it was so crazy the way it was like it tested a level. If that level, whatever happened at that particular level, it moved the volume instantly. To me, the one really interesting thing that jumped out at me that got me a little bit bearish was, well, it doesn't look like it anymore. Now it's changed. But this node up here, when we were trading in there, or sorry, I guess maybe it was this one. No, it was that one up there. It was like all stops. Most of the volume in here was just green. It was like all stops. And they were just waiting to get filled. And so I was thinking to myself, if they can't get up there and take out those stops, those sellers are beautifully positioned to take the market lower. Like, they're just zero risk at this point. And that's why when we broke that support, I was sure we were going lower. Because I was like, these sellers, they're strong. They got no reason to get shaken out. F4, are you doing any trades, Pirate? Yeah, I mean, I was trading like crazy during that. I don't know if I want to buy this support for the rotation, though. I think my brain's too tired. I can't take any more stress today. New sellers at the low. That's bearish. Damn, well, getting below yesterday's low is bearish too. Man, it looks like they want to break lower. All right, the survey is out. If you're new to the stream, we always like to take a little survey in the last 30 minutes of the day and guess where we think the market is going to close. So do you think we're going to head all the way back up above 3,900? Do you think we're going to stay stuck in the range between 3,900 and 3,850? Or do you think we're closing down here or lower? Are you looking for a spike down? Where do you think the market's going to close? Your votes are totally anonymous. We won't know who you are or what you picked, but you will be contributing to the groupthink, which is always fun and always interesting. So do please consider a vote. Survey is only going to be up for about 5 minutes. All right, testing the resistance at the or at yesterday's low. Last chance. We got 150 people hanging out, but only 60 of you are willing to guess where the market's going to close. Come on, get after it. Don't be afraid. You can be wrong. What do you think? Let us know. All right, the results are in. 60% of you think we're closing down here. 35% think we're closing inside the range, and only 3% of you, which is like probably what, 2 people, think the market is going to go back above 3,900. So if you wanted to inverse the chat, you would be long the market. Mateus, balance area confirmed. Interested to see which way we break out. I mean, it certainly looks like they want to break lower. I mean, never say never, but look at that daily. Generally, a big wick like that is not good to see. All right, Dylan, we'll catch you next time, bro. Correct. New sellers piling on. And we got a spike down. That is bearish. Ishman. Ish. All right, well, right through that that large node like butter. So that was fake. And now they're flipping the book, trying to take it lower. Okay, this is the last real support here. We got around 26. Then the next target is a repair of 38.20. Timber. 4. Somebody was asking about old gaps. Here's a great opportunity. So there's a gap here from 714, a gap that's like 2 months old. If we re-enter, guess what my target would be? Filling the gap. Have I been thinking about it prior to this moment? Nope, never even crossed my mind. But now that we're heading down towards it, I'm like, uh-oh. course, that doesn't mean we're going to do it today. Just make a note. Scooball says, not much time. That's true. They only got 20 minutes. And 10 of them belong to the murder bot. Scooball, NQ at last support. Yes, sir. Right at that bounce area low. Okay. That weak reference is repaired and we're down in the gap. Extremely bearish. It's hard to imagine, but the gap fill will be down to 3,800. Jeremy Jones got to tee up the micro long for the overnight. Put a take profit in. I definitely agree with you. They'll retrace some of this in the overnight, but man, this is a, I mean, this is a break of the bounce area. That's it. That's bearish. So the best you might do is the overnight coming up to test those balance area lows. This was a change in the market. And that change was bearish. Ben, funny thing is it's already 3,800 on the SPX. Yeah, they're usually about 10 points off from each other. Is the gap filled would be the question. Where's the SPX? Yeah, they haven't quite filled their gap. So they've got just as much distance to travel as us. Their gap is down at 37.95. "777 says Monster Day." That's one way to put it. All right, there's the Murderbot. What you got, Murderbot? Whoa, whoa, whoa. What you got, Murderbot? Whoa, whoa, whoa. Not like we're going to notice any difference in tempo. Scuba. Yeah, Murderbot's like yelling at his mom right now. "Mom, my big brother destroyed my room." He just shit everywhere. Yeah, that's a great observation, Scooball. That when those bots turned off, you can see, there's a lot of volume in here. There's lots of like blue and a lot of color in here. And right when that clock strikes 5 minutes before Murderbot, that volume disappears and suddenly it's all black. But look what stayed. Was that support there and there and there. So that's not bots. That's somebody really putting in orders. Also, you got the fact that after the first test worked, right? Look at how little volume there was. The first test worked, and as soon as it filled and started to head higher, boom, they brought in a ton of more volume there. They were like, yes, we want to fill even more at this level. Let it come back down, got themselves a nice big fill. One more little poke, and then... You gotta be a scalper though to really use that quickly. Mark, crash it now. I don't care if Grams and Grams suffer. Time for ES 3000. Yeah, what was that level I was looking at the other day that just scared the living shit out of me? It was like I was looking at the SPX. Yeah. So the trend line on the SPX, like the larger trend line, and the 618 perfectly aligned. The 618 retracement of the Fibonacci from the COVID lows, which obviously 618 is a very common retracement level. That's down there at 3,200. Needless to say, that'll be a great time to buy for the long-term portfolio. David, the orange cloud below is waiting to buy or short. You can tell, we can't really tell here, but you can tell the difference based on how much of the delta compares to the overall volume. So if it's, if you got a big node of volume here, but you got flat here, then it's the same number of buyers and sellers. So you've got a bunch of stops in there. Those are people who went long. Maybe they went long in here or whatever, and they just put their stops there. Whereas like if you look up here, you can see a big node of volume and you can see it's all sellers. That's real resistance waiting to fill with new sellers. Peter, fib scales like this are wrong. Long-term charts in arithmetic, or I can't say that word, scale, are all wrong. Well, we'll see. Let's see what happens. You can tell me I'm wrong when we get to 3,200. We don't find support. Dude, if they get a gap fill, I don't even know how to react. 1 minute. Can we do 10 points in 1 minute? Chirp, we'll catch you next time, brother. They left 4 points behind. So still some gap to fill come tomorrow. All right, guys. Well, not much to say here. That's bad. That is bearish. I mean, it's a spike down, so spike rules are in play. Do we open inside the spike tomorrow, above the spike, or below it? That will give us some insights moving forward. And I would be looking for resistance around 3850s in the overnight. And with that, I will bid you all farewell. See you here tomorrow morning. Thank you so very much. 83 likes. Can we bust 100 before we all leave for the day? Is there 17 of you willing to push that thumbs up? At the very least, you should give me some credit for calling the break of the low and the bearishness at the end of the day. Come on. It was a cool 40-point move. Nope. 40 points, not good enough for a thumbs up. Got it. Thanks, guys.